Up next, it's our turn to turn our attention over to the markets. And this week, there's plenty to unpack. The Federal Reserve reduced their interest rates by a quarter point midweek, while corn and soybean prices continue to tread water as a potential bumper harvest is looming. Joining us on the Market Journal desk this week is Darin Fessler of Lakefront Futures and Options. Good to see you, sir.
You as well. Thank you.
Let's break things down. Corn, soybeans, and wheat. Let's first just start out, get your general thoughts on where prices are at for those three commodities.
You know, on the corn side of things, we've had a nice little bounce up here with, I think there's definitely some concern, and I think what we're hearing is it's a valid concern here from the disease pressure we're seeing across Iowa and Illinois, parts of Nebraska. There's a tremendous amount of southern rust going on in Iowa and Illinois, and then guys have had a double whammy with tar spot, and beans have followed suit here. I think beans are kind of the laggard of the three, if you will. I think wheat is leading the way here, though, or trying to push corn here. And again, I think this crop is getting smaller by the day here. I do not think this is a getting any larger by any sort of the measure here. I mean, especially Iowa and Illinois, these guys are not even going to be close to some of these things last year, I don't think. There's going to be pockets of good, but there's a lot of disease out there.
Okay, well, let's break things down commodity specific. Took a look at your notes you posted online this morning. You said funds remain heavily short in corn and wheat, showing only small short in soybeans estimates, of course. How do you think influence-wise managed money positions are going to be having on the day-to-day trading? Well,
I think when you look at this week's lowering of interest rates, it could provide a risk-on sediment to the ag markets. I think you need a catalyst, though. I think you need the USA to come in here, step in here, and say, hey, these yields are declining. Now, hopefully, let's knock on wood, we don't see any acreage increases like we had the last two reports, but the yields are going to come lower here. There's no doubt in my mind. I think this is much more closer to a 180, 182 crop, and 182 probably at best here. Maybe that's the catalyst. We still see very good export sales on corn as well. I think where it gets a little bit of a problematic is when you get to the bean side of things. Beans, I think the bean yields come lower. It's going to have to be driven by domestic demand, because when you start looking at U.S. versus Brazil, we're not competitive. We are simply not competitive, and I think there's a lot of wishful hoping that China is going to come back, buy some U.S. beans, and I just personally think it's wishful thinking right now. We're not going to move or force China's hand to do anything they don't want to do personally.
Why is that?
I think it's all politically driven. I think it's mostly politically driven, but when you look at the economics of it between now and March, Brazil is much, much cheaper origin to source beans. And when you get out to the March timeframe, as of right now, the assessments show Brazil is about $3.50 cheaper than us for U.S. Gulf. So even if China wants to buy a lot, economically it would not make a lot of sense. Could they throw some bones at it and, hey, we're going to buy some of beans, but we're going to get something over here? Sure, they could do that, but they're not going to be stepping in here massively and buying U.S. beans, in my opinion.
You mentioned the discount there. Is that shipping prices factored into that, or is that the price of bulk commodities just compared to country?
That's beans from U.S. Gulf or Brazilian origin going into the ports in China.
Yeah. All right. Well, we've got all those factors. You mentioned USDA coming in lower and kind of their expectations. We did recently have the September crop report, WASD, so we're about a month out perhaps from USDA stepping in again. You do have expectations of that on the next report. They might continue to trim the yield, though.
Yeah, if the verifications are what I'm continuing to hear across the country, absolutely. These yields are not close to mid-180s. On corn, I mean, I'm hearing guys in parts of Iowa and Illinois that are 10, 15%, let alone bushels, off of last year. I have quite a large book, and there is not a single guy has told me year over year that has started harvest, my yields are better on corn so far. Maybe that will change, maybe it holds, but right now, nobody has said yields are better than last year.
On the topic of corn, have seen pretty good exports, especially on paper, as we continue to see those numbers come in. But how's the global competition weighing in? Can we continue to see strong exports as harvest is underway and will continue?
Yeah, if you look at FOB corn exports prices, I mean, we're some of the cheapest, if not the cheapest, major exporter of corn in the world. Again, I think when you look at the balance sheet on corn, I think the export side is going to be really strong. I don't see how it's not. The only thing on the balance sheet where I'm a little bit more concerned, I think the feed and residual side of things is a little bit lofty. Now, again, I do think exports remain strong. Maybe that feed and residual offsets that optimism in exports a little bit. But when you look at, say, like the technical pattern in corn, if we can start taking out December corn, which is following the 5-year seasonal very well, if you can start taking out that 430 level, there is a potential inverse head and shoulders that could potentially get it back towards that upper 460s, 470s. But again, I'm telling guys right now, don't hold your breath for that. Don't wait for that. Just step in, reward these 20 to 40 cent moves, because this is still, no matter how you slice the pie, given the acres, a pretty large corn crop.
All right, let's talk wheat for a second. Of course, across Nebraska, that has been harvested for a while. Perhaps people have it stored in the bin. Want to know what they should do. What's your outlook here short term for wheat?
I think wheat, relative to a lot of other commodities around the world, we're very competitive with U.S. wheat out of the U.S. Gulf. PNW, not so much, but we are competitive on the Gulf. I think wheat is very beat up here. Fundamentally, we still have a lot of wheat in the world, but exports out of the U.S. are remaining very, very strong. If you look at the KC, Chicago markets, I want to lean friendly this market. Both of those markets technically have a falling wedge with 69% of the time. That is a bullish technical indicator. If we can get through some recent resistance levels, I think wheat can follow, and I think if wheat runs, corn's going to be dragged with it.
What's the risk in wheat right now?
I think the risk here is that you continue to have the Black Sea area, which is very competitive, like Russia, Ukraine, continue to flood that market with a much cheaper origin if they're going to places like Europe. And Australia looking off a pretty good crop as well. So those are some big factors. It's just destination of origin is our biggest competition right now.
Let's wrap up going back to corn and soybeans, because that's what's going to be harvested. It's harvesting right now. We'll continue here in the couple of months ahead. What advice are you giving producers as it stands today?
Well, as we stand right now, I think there is some upside in corn still. We've been leaning friendly about the last 4 weeks here in corn. We're going to continue to lean friendly. Seasonals continue to work out here from what we did last year. 5-year seasonals work out pretty good. I still think 20, 40 cent rallies in corn, you need to reward those. Look for reownership on pullback. Beans, 50 to 60, 70 cent rallies, reward it. Look for some reownership on pullbacks. I think you're going to get that opportunity with uncertainties in South America, but if you get up towards 11, reward it, reward it, reward it.